G'day everyone, Greg Canavan here with a Rum Rebellion video update. Going to get straight into it today. I've got quite a few charts I want to go through with you, and really the underlying theme for today is I guess the dominance of central banks and their ability to continue to prop share prices up around the world, but mostly I'm going to focus on the Aussie market. So let's have a look at the first chart here. This one shows the All Ordinaries, and I've just got marked there that we've seen a 25% rally in the 6 months from the low from late December 2018 to the high we saw just a couple of weeks ago. So from a historical perspective, 25% in 6 months is a very strong rally, and most of that has been caused really by central bank activity. In Australia, we never raised, the Reserve Bank never raised interest rates at all. And in the last couple of months, they've cut rates twice down to 1%, with expectations that they'll go lower as the economy weakens. So very unusual situation in that you've got increasing share prices in a fragile economy, but in saying that, tax cuts, interest rate cuts, are providing a bit of stability to the economy, and at the very least that should maintain earnings for companies. So you know, I don't think we're going to see a crash or anything like that. I guess what I'm suggesting is that a 25% rally in 6 months, some of that needs to be given back at some point, but really the momentum and the economic narrative is that central banks will continue to prop markets up for the time being. So as long as that's happening, you're not really going to see a pullback or a big pullback in markets. But if you look at the next chart, you really see the influence of central banks in the gold stocks. Aussie gold stocks have had, well, I guess you'd call it a complete and utter melt up in the last month or so. And that's really been driven by the large stocks like Newcrest, Northern Star, Saracen, Evolution Gold, Regis Resources. All these stocks are making new highs, and because they're large caps, they have a big weighting there in the main index. So look, you know, I would expect to see, even though I'm bullish on Aussie gold stocks, I would expect to see this sector pull back in the next month or so. But in saying that, I'd say that would provide some really good buying opportunities once again if you wanted to get in after a solid pullback. And if you scroll down below the video, you'll see a special report that I've put in there today nominating 2 gold stocks that are worth having a look at and perhaps picking up in any subsequent pullback we get in the next few weeks or months or whatever. But really, if you look at that chart closely, it's hard to see how that parabolic move can be maintained, and most moves like that do result in a bit of a pullback. Once again, next chart, resources index, you're seeing a melt up continue there from the start of the year. We're just going higher and higher, and that's really on the back of record iron or near record iron ore prices, along with really good performances from BHP, Rio, but a lot of the large resource stocks are really doing quite well. Next chart is the industrials. That's done very well this year, nearly up in a straight line. There's been a few pullbacks, but you know, very bullish move there, and that was really helped along by the interest rate cuts. And if you can see closely, you see some spikes there in the market in the price in the last few months, and that was really in relation to the expectations of interest rate cuts. Next chart here, which is quite interesting, is the Small Ordinaries. Broke out to a marginal new high yesterday, but as you can see, it's now bumping up against the highs from early 2011, late 2010. So it'll be interesting to see whether that acts as a bit of resistance for the small ordinaries, or whether it can punch on through there and continue to go and challenge the all-time highs that were reached back in 2007, which is on the next chart, which is what the All Ordinaries are doing. So this is the market as a whole. Earlier this year or a few months ago, broke out to new highs, and it is now right up against the highs that were reached back in 2007. So this is a really important juncture, I think, for share prices. And even though you're seeing, or the feeling is a very bullish outlook in markets, and there's not a lot of concern about share prices pulling back, it is interesting that share prices are stalling a little bit around these 2007 highs, and it could indicate that, you know, this is a considerable area of resistance for markets, and it might If it can't punch through there in the next couple of weeks, it could be an indication that we're going to see a decent correction unfold, perhaps throughout the second part of 2019. And just on that, like if you look at the next chart I've got here is emerging markets, and the final few charts I've got for you today are really about getting a better sense of the underlying economics. So the charts I've shown you above, central banks and liquidity, global liquidity flows have had a big influence on those markets. But that's not flowing through to the emerging markets, and the emerging markets are generally pretty pushed higher by global liquidity concerns, but that's not happening right now. So there's a case to be made that the underlying fundamentals of the global economy just aren't strong enough to get global capital interested in emerging markets at the moment. You can see there that after peaking in 2018, there's been a pretty weak rally in 2019 so far. The market's sold off again and really can't break through any form of resistance. So that's a concern for the global economy. Next chart here, same sort of picture here is the Shanghai Composite Index, which is the Chinese share market. Had a big rally in 2019, but it's pulled back and now it's really struggling to get further. Obviously, there's the trade war concerns on China's economy, but really there's potentially other things playing out, namely China's huge debt pile that they have to service, and as economic growth slows, that becomes harder to do. So the Chinese authorities, they're putting a fair bit of stimulus into the economy, but they're also conscious of not pushing that debt bubble too far, because it could get even more destabilizing than what it already is. And finally, just a chart on crude oil there. Once again, big pullback big correction, bear market in 2018, and the oil market's really struggled to rebound, and it's now starting to trend lower as we head further into 2019. That's an economically sensitive commodity, so it's just telling you that the underlying global economy is not particularly strong, which makes me very wary about buying stocks here purely on the basis of central banks providing more global liquidity. US Central Bank, the Federal Reserve, meets next week. There's pretty much a 25 basis point cut already priced into the market. So really where we go from here will depend more on central bank communication rather than any fundamental information, unless of course you start to see in the US reporting season, which we're in the middle of, some profit warnings. So it remains to be seen what's happening there. But look, the message is the same as my last couple. Really wary about buying or getting too bullish at this point in the market, because we could really be at the point where a decent correction plays out. All right, I'll leave it there for today and catch up with you next week. Thank you.